To calculate our monthly student loan payment under a federal student loan, by default, we are enrolled in a standard 10-year repayment plan. And how that works is, first, we start with our student loan balance. And in our example, we are going to use a student loan balance of $240,000. Then if we ignore interest rate for the purposes of our example, if we take that balance and divide it by 10, we get an annual student loan payment of $24,000. If we take that payment and divide it by 12, we end up with a monthly student loan payment of $2,000. If you are a fourth-year medical student or a resident that is yet to take any action on your student loans, I need you to listen carefully. By default, as I just showed you, you are enrolled in a standard 10-year repayment plan. So if you have a high student loan balance, your payment is going to be calculated based off of the amount you need to pay down your loans in 10 years. You get the opportunity to actively enroll out of the standard 10-year repayment plan and go into a income-driven repayment plan. And we'll talk about that right after this. And that income-driven repayment plan is special because instead of a calculation that's used to pay down your loans in 10 years, with a income-driven repayment plan, it is your income that is used to calculate your monthly student loan payments. Income-driven repayment plans are an awesome opportunity for residents, fellows, or attendings because unlike the standard 10-year repayment plan that uses your student loan balance to determine your monthly student loan payments, under an income-driven repayment plan, there are only two factors. The first factor is your income, and the second factor is your family size. And depending on your income or your family size, as they increase or if they decrease, that actually will impact the amount of your student loan payments. So one of the requirements under an income-driven repayment plan is you have to recertify your income every year. And by doing so, you're proving two things. The first, what is your income right now? And then number two is, has anything changed in your family? And those two factors are what are used to calculate the payment side for an income-driven repayment plan. I like to think of income-driven repayments like owning a house, where depending on the size of your house, that is what represents your income. So if you are a resident or a fellow and you have a modest income, you may have a smaller house. However, as soon as you become an attending and your income increases, the size of your house also increases. And how the family size works is depending on the size of your family, you are given a floor price. So we start with an income, which is, the size of our house. And then we have a floor size based on our family. So just think of it this way. If our family size is 1, our floor increases. If our family size is 2, it increases again, 3, it increases again, and so on and so on and so on. But the difference between your income and the floor is what is the basis that is used when calculating the income-driven repayment plans. When calculating our monthly student loan payment under an income-driven repayment plan, recall there are two factors. The first factor is our income. The second factor is our family size. And how the family size factor works, if you recall, is it's a floor that we're given based on the size of our family. So if we have a family size of 1, we would get a floor of $20,000. If our family size is 2, our floor would be $25,000. If our family size is 3, our floor would be $30,000. Now, these are not exact numbers because they change annually, but they will give us a good ballpark of how to do our calculation. So from there, all we have to do is plug and chug. So by using the formula on the bottom, we start with our income. So in our example, we are going to say we are a single resident making $60,000. So our income is $60,000. Then we subtract out our family size factor. So because we are single, our family size factor is 20,000. So if we take 60,000 and minus 20,000, we're now at $40,000. Then if we multiply that by our discretionary income factor, and this is a number that's determined based on the income-driven repayment plan you are in, but in most situations, you will be at 10%. So if you multiply 40 by 10%, we are now getting an annual student loan payment of $4,000. If we take that number and divide it by 12 months, we now have a monthly student loan payment of $333. If you recall, under the standard 10-year repayment plan that we are in by default, our monthly student loan payment was calculated based off of our student loan balance, and that was a number of $2,000. By enrolling in an income-driven repayment plan, we are able to take that $2,000 a month payment all the way down to $333.
Wow.
We are now going to talk through the different income-driven repayment plans. The first income-driven repayment plan is called income-based repayment, or IBR. This is the least popular repayment plan, and it's actually broken up into 2 different plans. We are just going to focus on the plan for newer borrowers. So if you are a borrower, a new borrower on or after July 1st, 2014, your payment is made up of 10% of your discretionary income. Your payment is also capped at the 10-year standard repayment plan. So how that works is, let's just say you are a surgeon and your income skyrockets in the future. Instead of using your high income to determine your monthly payment, it gets capped at the 10-year standard repayment plan. If you make 20 years of qualifying monthly payments, your student loan gets forgiven at the end of that period. The second income-driven repayment plan is pay as you earn, or PAY. This is one of the 2 more popular income-driven repayment plans. And this plan, the payment is calculated based off of 10% of your discretionary income. Just like IBR, if you are a high income earner, your maximum payment gets capped at the 10-year standard repayment plan. And if you make payments for 20 years, your loans get forgiven at the end of that time. But one special note about pay is you are given the opportunity to file your taxes separately than your partner. And why this is so important is, instead of using both of your incomes to come up with the calculation for your monthly student loan payment, by filing married filed separately, you can only use your income to determine what your payment's going to be. The only caveat to pay attention to is your taxes will change if you take advantage of that opportunity. The third income-driven repayment plan that we are going to talk about is revised pay-as-you-earn, or REPAY. And this plan is also based off of 10% of your discretionary income. However, how it differs from IBR and PAY is Unlike those two where your maximum payment is capped at the standard 10-year repayment plan, under repay, there is no cap. So depending on the calculation for your income-driven repayment, that is the amount that you will pay on your student loan. Additionally, the student loan forgiveness piece is broken up into two pieces. The first is by making 20 years of monthly payments. That is the duration of time it takes to pay off your undergrad student loans. If you have graduate student loans, those get paid off after 25 years of monthly payments. And the special feature that is unique to repay is around the interest subsidies for any unsubsidized loans. And how that works is with an income-driven repayment plan, your monthly student loan payment is based off of your income. However, if we were to calculate the interest owed every month on your student loans, how that is calculated is by taking your student loan balance and multiplying it by the interest rate. And because the income-driven repayment doesn't keep up with the interest, any difference gets added to your student loan balance. So with repay, what happens is the interest piece is cut in half, and only half of that interest gets added to your student loan balance.
Public Service Loan Forgiveness, or PSLF, is a special program that is different than the income-driven repayment plans. This program is layered on top of that program. And what I mean by that is if you follow certain requirements for PSLF, you earn the opportunity to get your loans forgiven in a sooner period than the 20-year or 25 years for income-driven repayment. The qualifications for PSLF are as followed. The first is you have to have direct federal loans. Second, you have to be employed full-time at a nonprofit 501c3 or a government employer. Third, you have to make 120 on-time qualifying payments. And lastly, you have to be enrolled in an eligible income-driven repayment plan. A bonus tip is it is encouraged that you fill out the annual PSLF certificate annually to make sure that you are tracking your payments and making sure you qualify for PSLF. And if you follow those requirements, at the end of 10 years, your loans get forgiven, tax and penalty free. And that is a huge deal because unlike income-driven repayment plans, where you have to pay 20 years or 25 years to get your loans forgiven, under those two plans, when you get your loans forgiven, it is a taxable event. So if you have $50,000 or $100,000 of student loans left at the end of a income-driven repayment plan, though that forgiveness, the $50,000 or the $100,000, gets taxed at your ordinary income. So that is an area of planning that you have to pay attention to when you are putting your financial plan together. As a recap, to calculate your monthly payment under an income-driven repayment plan, there are two factors. The first is your income, and the second is your family size. And it's fairly simple to determine your family size. However, how do we calculate your income for the purposes of determining your payment? And there are two ways to calculate your income. The first is what's called an adjusted gross income, and that is a number that is found on your tax return. The second factor is an alternative documentation of income, and there are a bunch of different ways that you can document your income, but for a resident or a fellow or an attending, the most likely document that you will use is your pay stub. When calculating our income for an income-driven repayment plan, there are two ways to do so. The first is our adjusted gross income, and that is a number that comes from our tax return. The second is a alternative documentation, and that comes from a pay stub. So in order to understand which method to use, we first have to understand a general timeline. So in this example, we are going to show a third-year medical student transitioning all the way into intern year. So if you picture this with me, we're starting in the middle of our third year, and we're in January, February, March, April, and May of our third year. Typically, we get a small summer break, and then we start back up in our fourth year in August, September, October, November, December, and that carries into the following year. So in order to understand adjusted gross income, we have to understand how taxes work. And how taxes work are every April, we file a tax return for the income that we earn in the year prior. So for most of us, because we are in medical school, we are not earning income. Occasionally, we may have a partner that we're married to, and they have income, and that has to be taken into consideration for our monthly payment calculation. But for most of us, we get to show $0 income. So when we file our tax returns the following year for the income that we earned the year prior, we get to show a income of $0. And that $0 is used to calculate your monthly payment. So if we show $0, our first year of student loan payments would be based off of $0 payments. Alternatively, let's say we did not file a tax return. How do we calculate our payments? And if we didn't file a tax return, we have to use our alternative documentation of income, and that would end up being our pay stub. So if we continue our time frame, right, we went from our third year to our fourth year, and then we start back up in January, February, March, April, May is when we graduate. We get June off, and then we start our intern year in July. And the only way to get our paycheck is after we start working. So how the payment gets calculated is we take our first paycheck and it extrapolates out what that payment would be for the full year. So for most of us, our salary for our first year is around $60,000. And that is the payment that is used when calculating our income-driven repayment plans. So if we used $60,000 for our calculation, our payment would be around $300 to $350. So by filing a tax return, our payment would be $0 versus if we used an alternative documentation of income, our payment would be closer to $350. Now let's take a step back and talk about the timeline for your student loans. In medical school, your student loans are in a status called in-school status. And what that means is when you are in school for most of your loans, you are not required to make any monthly payments. Then, in May, when you graduate, your student loans will flip out of in-school status and go into a grace period status. And how the grace period status works is there is a 6-month period of time after finishing school and your loans flip out of in-school status that you are also not required to make any payments on your student loans. So let's go to our time frame. We graduate in May, then we have June, July, August, September, October, and part of the way through November that we are in our grace period and we do not have to make any required payments towards our student loans. Then, in the end of November, early December, is when our first payment for our student loans is made. So we go to our timetable, and part of the way through November, early December is when our first payments are made. So as a quick recap, when we're in medical school, for most of our student loans, we are not required to make any payments. Then we graduate in May, and within a couple days, our loans will flip out of in-school status and go into a grace period status, where we have 6 additional months before we are required to make our first student loan payment. And that first student loan payment will occur at the end of November, early December timeframe. If we are going towards public service loan forgiveness, our first priority is to consolidate our student loans. And what consolidation is taking all of our different student loans and blending them into one student loan with one average interest rate and one payment. And when we do that process, we are moving our student loans from our current servicer to MOHELA, which is the servicer responsible for public service loan forgiveness. Why we want to consolidate our student loans. Recall that by default, when we graduate, our student loans go into a 6-month grace period. And one of the events that happens during consolidation is we trigger our first payment to happen sooner. So if we graduate in May and immediately consolidate our student loans, it usually takes 2 to 3 months for the application to process. So our first payment will happen around August instead of waiting until November, December. And why that's so powerful is earlier in our careers, our income is lower than later in our careers. And the goal for us with public service loan forgiveness is we want to pay as little towards our student loans because at the end of the 10 years, if we qualify, our loans get forgiven tax-free. So there is no benefit for us to pay more towards our student loans. Additionally, if you recall, when we enrolled in an income-driven repayment plan, our income is calculated based off of our tax return or our pay stub. And if we use a tax return and we made no income in medical school, our first year of payments would be $0. So even though we're pushing up the timeline, there's a good chance our first payment, if we filed a tax return, would be $0. And that payment would continue for the first year of our payments. So why we want to consider consolidating earlier is we get the opportunity to make more payments into public service loan forgiveness when our income is less, and towards the end of public service loan forgiveness, when our income is higher, we have that many less payments to make. Now let's talk about how fourth-year medical students can crush public service loan forgiveness. Let's remember, when enrolling in public service loan forgiveness, we have to also be enrolled in an income-driven repayment plan. And recall that with an income-driven repayment plan, there are 2 ways to calculate our income. The first way is our adjusted gross income, and that is a number that comes from our prior year's tax return. And the second way is our pay stub. In our example, we are going to say we are a single resident making $60,000, and we are going to start using method 2 and our pay stub. So if we were calculating our monthly student loan payment, we start with our income of $60,000. Then we subtract out our family size factor. So because we are a single resident, as I'm recording this, our family size factor is $20,385. If we subtract those from each other, we are now at $39,615. Then we multiply it by our discretionary income factor. That is going to be 10% or 0.1. And that brings us to our annual student loan payment of $3,962. If we divide that by 12, we get a monthly student loan payment of $330. So if we use our pay stub, our first year of payments would be using $330. So now let's go back to our time frame and understand how that payment will look. So remember, in May is when we finish school and graduate. For most of us, we will forget about our student loans until we have to make our first payment. So we start transitioning into residency in June, and we start our intern year in July. Then we have our 6-month grace period once our student loans flip out of in-school status. So if we forget about our student loans and make our first payment after the 6-month grace period at the end of November, early December, our first payment would be our $330. Then that would be our payment that we make for the first year. So we would pay $330 per month, and I'm just going to end it in June, which is 7 months paying $330. So in our first year, using our pay stub, our payments would total $2,310. Now, let's show the example of us filing with our adjusted gross income. And remember, our adjusted gross income uses our tax return that we would file in April for the income we earned our last year of medical school. So for most of us, it would be $0. So our income using our adjusted gross income would be $0. We would have the same family size factor and discretionary income factor. And if we divide it by 12 months, we have $0 payments. So by using adjusted gross income, we can take our payments from $333 a month to nothing, just by filing a tax return in April showing $0 income. So let's take that and supercharge it even further. And recall that your top priority when enrolling in public service loan forgiveness is to consolidate your student loans as soon as your loans flip out of in-school status. And when you consolidate your student loans, what you are doing is triggering your first payment to happen sooner than the 6-month grace period. So if you follow the schedule religiously, and as soon as your loans flip out of in-school status, after filing your public service loan forgiveness application, your first payment would be sometime around August based on the time that it takes to process your application. When consolidating, one, we kick up the timeline and we end the grace period sooner, but two, if we filed our tax return, that really doesn't matter because our first payment is going to be $0. And that $0 payment would happen for the first year you are in residency. So by consolidating your student loans and filing a tax return so we can use our adjusted gross income, we save ourselves $2,310 in the first year because we are not having to make our payments using our pay stub. Now let's take that one additional step further. And with public service loan forgiveness, we are required to make 120 qualifying payments. If we are the average student loan borrower and take advantage of the 6-month grace period, that means at the end of public service loan forgiveness, we are going to have to make 6 additional months of payments when our income is higher. So imagine not today, but 10 years out, what your salary will be. So in our example, we're just going to say our salary will jump to $300,000. What would those student loan payments look like? So we would just follow the same timeline. And if we plugged in all of the numbers, our monthly student loan payment would be $2,330. So each of the last 6 payments, if we took advantage of the 6-month grace period, would be $2,330. And that would total $13,980. However, if we consolidated our student loans and made our first payment in August, that means we are making 1, 2, 3, 4 additional payments towards public service loan forgiveness earlier when our income is less. That means at the end of public service loan forgiveness, we have 4 payments that we don't have to make when our income is higher. So by consolidating our student loans in August, on the backside, we get to save $9,320. The huge opportunities by consolidating our student loans and filing an electronic tax return in April is, in our first year, we get to save $333 per month in payments. And if we did that for 7 months, in our first year, we have $2,310 to be used towards other planning obligations. Additionally, because we kick in public service loan forgiveness 4 months earlier than waiting the 6-month grace period, on the backside, there are 4 less payments we have to make when our income is higher. So at the end of public service loan forgiveness, we get to save $9,320.